Good afternoon, everyone, and welcome back. This is Daily Trade Analysis with a quick market update for today, March the 15th. PPI month over month and year over year came way lower than expected. We expected month over month 3.3, but we got negative. And year over year, we are decreasing from 5.7. We were expecting 5.4, and we got 4.6. A big decline. Well, deceleration in the acceleration of the inflation in the wholesales. Regarding core PPI, year over year decline from 5 to an increase of 4.4. This is big. The expectation was 5.2, and the only thing that is slightly bad is that core PPI month over month, it was actually flat. We were expecting 0.4 and it's flat. It's not decreasing. Retail sales month over month on February, big decrease, minus 0.4 from the previous one, 3.2 in the positive. We're expecting minus 0.3. And excluding gas and autos, 0%. Retail sales year over year is a big decline from the 7.7 to 5.4%. So all this economic data is showing that inflation on the producer side and retail shares are way lower than expected, and this is supposed to be good news. PPI was an expected decline of 0.1, and the New York region manufacturing, the New York Empire State, posted a minus 24 from the minus 5 and expected minus 8. Big decrease, minus 24.6, reading down 19 points from a month ago. This is supposed to be good. But what is happening then? Well, a lot of news today regarding the bank sector. Again, we have to follow these incidents, because in these incidents are the key to understand the overall sentiment. So on one hand, we have pretty decent, I would say good PPI data, but on the bank sectors, we have a new one. Credit Suisse shares tank after Saudis backed off or further assistance. One of the biggest, well, actually the biggest baker of Credit Suisse is the Saudi National Bank. And he has said that it won't provide further financial help. And, well, what happened then? Credit Suisse was 30% in the red in pre-market. Since the open, though, we are 16% up. So right now, only, according court, only minus 18% in the red. But still, financial sector banks are still in the focus. XLF, look at this gap. It's down 3%. It was almost 4%, and it's just chopping around. It's continuing lower, adding up to the bearish sentiment that everyone's having. Even though we bounced yesterday, we are gapping down again today of fears of a big financial crisis. Well, more news. Due to Credit Suisse tanking, European stocks slide 2.5 and certain banks briefly halted down from trading. So this is not only affecting US banks, but also financial system in Europe. And more than that, remember yesterday that Silicon Valley was the big topic of the day? Well, the SEC and the Department of Justice are investigating if banks executives sold any stock prior to the collapse. I mean, anyone would have short the market in this SVB stock if they would know. But if they knew, but this is not legal. If you know that the bank is going down, it's going to melt down, You cannot just sort the stock and make a fortune. This is not following the rules. So please, SEC, go ahead and go after them. Next one, you remember Charles Schwab, the bank that got demolished yesterday, and it got again as the banks a big bounce. Well, the CEO said that he bought the dip, 50,000 shares. So they bought the dip. Let's see how it was. It's pretty decent. Pretty decent. If he bought the dip down here yesterday during the bounce, we are now consolidating. But this is not what it's all about. This is all about these kind of things. There are banks that have issues managing the money flow and their investments. And now that they got caught with the hikes on interest rates throughout 1 year, they have to pay a price. They cannot just bail out or say, yeah, I bought the dip because look, this is a pretty big discount. No, this is not the key issue here. The key issue is the mismanagement from all the banks, starting from Silicon Valley, going to Silvergate for crypto, and also Charles Schwab, JP Morgan, and all those that have billions of unrealized profits because they bought bonds with a low interest rates, and now that they got caught with higher interest rates, they are holding on those unrealized, and this is not liquidity. Be prepared because this might be a black swan event. Be careful. GFC, the Great Financial Crisis, was one of these things, and more day by day we are learning new things about all these banks. So be careful. And unfortunately, the Fed faces a no-win situation. They would like to support the economy. They did support the customer of those banks that went into collapse, but they cannot support the economy because we are facing inflation. So every decision has its consequences. And they have to be prepared because the main fight is the inflation, not to save all these banks and the stakeholders of the bank's stocks. I hope Fed realizes that and continue hiking rates because inflation is not under control. But let's face it, there will be a lot of political pressures, economic pressures for them to not hike more interest rates. And let's see what happens next week if they continue with the plans of hiking 25 or even 50. Let's see how the probabilities are right now. For next week, 50-50, 50 flat, 50, 25 basis points. And the terminal rate is going to be 475.5. So we are pricing in 25 basis points and another 25 basis points in May. And from that, start decreasing until 325. So, well, that could be it. I mean, it could happen. It could happen, but let's focus on the Nasdaq. Nasdaq is now, look at this. This is the bounce of the 200 moving average, the white line that is holding the markets. Look at this. Big bounce. And I think this is the proper way of seeing things. PPI is showing decent signs of inflation deaccelerating. And I think if we check this previous resistance was now support, I think it can go out. I think this is the obvious reaction. We were basically chopping around throughout all the day, maybe going on lower, and I think big buyers committed into the 200 moving average with volume. I think people is accumulating for a bigger move in the next days, throughout all this week. Banks have an issue, yes, but I think Fed will need to step up to the plate and continue hiking interest rates. And I think this is what markets are pricing in. Slightly less hikes of 25 basis points, but for sure inflation, at least for now, from the PPI, is showing really signs of deceleration. Crude oil. Crude oil is worth noting that, well, once we broke this, we are going to 66, 65. This is futures, so we have some values from December 2021 that may need to be retested. And look at the volume, increased volume to the downside. So we broke down this wedge, and crude oil is showing signs of really weakness because demand destruction and high interest rates again. What else? We have to talk about dollar. Dollar is really strong. After the banks collapse, now people starting to again trust cash, trust the dollar. And not only that, the 2-year yield and the 10-year yield are way lower than it were before. And I think this is a good sign for futures interest rates because we are already topping. We did a lower high on both yields, and if these yields are going lower, I think we are pricing in inflation going down, and we have to start thinking about the economy. And the economy, from the bonds market perspective, this is the inverted yield curve, is showing good signs of recovery. Despite the fact that bank after bank are collapsing, I think people is realizing that the Fed will support customers, but not the financial system. Banks will pay their price. This is my understanding. And this is a good thing to know. Terminal rates on September this year went lower than 4 again. Big drop, big bounce, and now that we digested news of PPI, we are pricing and going down. This is a big spot to know, a big spot to watch. For September, and from the 3.9 on September to December, we have also a big spot to watch here right now, 3.6. So bonds market are pricing in way lower terminal rates and start cutting, Fed pivoting on September throughout the months until December to finish the year at 3.67%. This is a big. This is 100 basis points from now to the end of the year. This is an unbelievable cut. I don't think if this will happen. This is based on the fact that they think that Fed will start cutting more aggressively to support the economy. But let's see what happens next week. Right now, they are taking their bets and they are betting that Fed will start pivoting very aggressive. Finally, let's talk about the sector funds. Because when there are a lot of fears of recession, one of the things that you have to really pay attention is the sector funds. Wall Street is rotating to defensive. If we check the 1 day, we have XLU, communications, staples, and healthcare up here. These are defensive sectors. Be careful. Today, utilities, technology is up there due to low interest rates, but still, staples and healthcare are also there. Energy is melting down, industrials are melting down, financials obviously, but I think we have to continue watching these to see if utilities and staples start going up while the market goes down. Right now, the market is more or less deciding if it's going down or not. It's trying at least to break this structure. Let's see if we hold this level. But what is true is that, let's mark this as resistance. Let's see if this holds. What is true is that market is in the red, and some defensive sectors are starting to show signs of rotation. Let's see what happens, because we are in a very key moment to assess the situation regarding inflation, but also we have a lot of sentiment for these banks. And until next week, I think we are going to chop around in this wedge and decide if we go up or down based on what Fed will do next week in the interest rate decision. Last, let's check what else do we have this week. Tomorrow, Thursday, we have housing, and also this is not for US but for Europe, ECB interest rate decision. They are expecting to raise 50 basis points. Let's see what happens, because this kind of move might determine also the kind of move that US will do. But anyway, quite interesting data tomorrow, apart from the jobless claims, housing starts, and from the US. And on Friday, consumer sentiment and industrial production. Every good piece of good news, I think, it would push the market higher. I think it's key to understand that there are other issues right now on the economy, but I think inflation is showing signs of, I think we have to be a little bit positive and wait for Feds to react. 25 basis points would be ideal. 50, I think, will kill the market, and 0 would show signs of weakness on the economy. Something will be sick. I don't think 0 is happening. 25 will determine for sure that Fed's still hawkish on their fight to the inflation, but let's see what happens. We have to wait. Look at this bottoming tails on this resistance that might be support right now. We might see Nasdaq fighting for 12,300. Let's see. What is true is that we are seeing now, after a long accumulation throughout the day and choppy price action, we are starting to see some kind of move. Let's be patient. This is an unbelievable hard and tricky time to trade. So let's be patient, discipline, and let's look for those opportunities and try to understand what is happening in the overall market. And as always, thank you for your time. If you found this video useful, please remember to click the like button and subscribe to the channel to receive notifications when I upload new videos. I upload new videos every single day for market podcasts, market updates, and market recaps. I appreciate your time as always, but remember that the trading day is not over yet. We are at noon, lunch hour is starting. Let's see how power hour reacts this afternoon. But be patient, be disciplined, and remember that risk management is your best friend during these super hard times of trading. Stay safe, everyone, and see you tomorrow.